Welcome to Discovery Watch with John Kaiser.
I'm your host, Jim Goddard. Welcome back to the show, John.
Jim, pleasure to be back on the show.
John, what's driving up Forum Energy Metals has Love Lake delivered?
Forum Energy put out a press release today updating on its various projects at Love Lake, where they are drilling 3 targets, and this is a nickel, copper, platinum group metals play. The Corvin Lake target, they appear to have drilled 3 holes and shipped them for assaying. They have not told us what they intersected there. The disappointment earlier this year is that when they did an EM survey over all these big mag targets that had emerged last year, only the Corvin Lake mag target ended up having a coincident EM conductor target. And you need the conductor in order to have one of these massive sulfide magmatic segregation type systems. They have not given us any visual details, so we cannot tell whether or not they hit anything interesting. The other 2 targets, Watson and Corvin, those are nearby. Those are where they're simply following up on past showings and holes that nicked something but was never really followed up by the previous operators. And they're on the 7th hole. So I do not think there's anything that's come out of Love Lake that is driving the recent push in the stock price, which has hit 45, 47 cents the other day. And they also updated on Janus, on Janus Lake, which is the copper silver project, optioned 80% to Rio Tinto. And they said Rio Tinto has done an extra 9 holes on that Refuse target area, where they got 9 done last year and had the season interrupted by an early spring thaw. But again, they won't have any news on that until mid-October. And they did point out that Rio Tinto spent a lot of effort on further mapping and prospecting of that entire 52-kilometer long land package in the hope of finding additional hotspots. But none of that, we won't know whether there's anything that's got Rio Tinto super excited until probably November of this year. So neither Janus Lake nor Love Lake are driving this recent price rise. The price rise is clearly due to the fact that uranium finally popped out of its gutter level of $30, $33 and hit $40 a pound this week. The spot physical uranium trust has also jumped up. They now own 18 million pounds of U3O8, and other groups have also bought uranium in the spot market. The big problem with the uranium sector has been after Fukushima, the Japanese stopped all nuclear production and the Germans decided to pull the plug on nuclear energy. So we have had all these utilities destocking in the past decade, getting rid of their surplus uranium. It got to the point where Cameco shut down MacArthur rather than deliver on its $50, $60 a ton long-term contracts. It was smarter for them to between $20 and $30 to just buy in this surplus uranium from the utilities at $20, $30 and deliver that for their long-term contracts. But now that we have the private sector, the investment sector entered in the market, they are creating this giant warehouse where they are warehousing the spot uranium. And it appears that this week it finally hit a tipping point where enough of this uranium has been cleaned up that's coming out of the utilities to get the price up. And for people behind spot, they're hoping that this will repeat what happened in 2004 to 2007, where a similar uranium trust cleaned up all the spot that was in the market and ran the price of uranium to $140 a pound. And eventually that dragged and that started down at $10 a pound, and it eventually dragged the long-term prices to the $80, $90 a level, and that was really good for the uranium producers, and it was especially good for Kazakhstan, which came out of nowhere and is now the biggest supplier of uranium in the world from its in-situ recovery operations, where they drill the pipes in holes and put pipes in the ground and pump the acids into it and recover it without actually having to do what Cameco has to do in Saskatchewan, is develop underground mines to access considerably higher grade uranium. So the story now is that clean energy requires more nuclear reactors. But the World Nuclear Association has put out some data showing that really there's no supply-demand imbalance problem until 2028, 29, and that everything will be in balance until then, and that in the past 4 years, about 16% of existing uranium supply has been idled to deal with this imbalance of demand and supply. So there really isn't any reason for a significant shortage to develop over the next 8 years, but the uranium bug sector is determined to create a fresh bubble. And of course, the game isn't so much the uranium. The game is about all these juniors which have these existing deposits, and they would like to get that same sort of M&A boom that took place in 2006 and 7, where billions of dollars worth of juniors with various uranium deposits that had been found ages ago that they had managed to get hold of ended up being acquired by bigger companies, which all were bankrolled by the institutional money. So this time I think it's not quite the same situation, although the World Nuclear Association shows an awful lot of nuclear reactors in the planning stages. The ones in construction are not that significant a boost in total nuclear reactor future requirements. And the other ones, well, these are 10 to 20 year timelines, and the proposed part that's supposed to kick in sometime between 2030 and 2040, that's all based on the idea that somehow nuclear energy will form part of the nuclear or the clean energy future. But with the latest developments, Biden has suggested that he would like to have 45% of electricity generated by solar. That's up from 4%. And we even saw an old Isaac Asimov story about giant space, solar panels in space, 1,700 meters wide, collecting sunlight on a 24-hour basis and sending it back to Earth as some sort of laser beam. They're actually looking at this now again as a potential technological reality. And so the idea that nuclear energy is going to become a significant part of the long-term future, well, we won't know for 10 to 20 years from now. So all that is immaterial to the current hype surrounding the uranium. In fact, another thing to worry about is that the Department of Energy, which is responsible for storing 700,000 tons of depleted uranium, that's after that's what's left over after you take natural uranium and upgrade it so that you can use it for nuclear energy fuel or for nuclear weapons. Cameco and an Australian company, Silex, are involved in a test project involving laser enrichment technology, whereby they take this old depleted uranium and upgrade it back to the 235 isotope level that natural uranium has. And right now their plan is to only be producing 5 million pounds of this by 2030, which is still a fraction, a couple thousand tons out of the 60 to 65,000 tons that is consumed annually right now. But that 700,000 tons of toxic waste that the government is stuck storing, well, if this works, they could scale that up, and this could be a domestic supply of uranium fuel for the next 20, 30 years. So all these predictions about future imbalances, they are a bit of a stretch, but they don't really matter now because all of that is beyond, in a future that is well beyond the attention span of the market right now, which is into this idea of chasing momentum stocks. And this is what has helped Forum Energy Metals. Because back when I adopted it as a favorite, I said, well, the focus is Janus Lake copper silver and this Love Lake nickel copper platinum potential. But the company was involved in $50 million worth of spending during the whole uranium cycle from 2005 onwards until they finally gave up on it in 2017, 2018, but they still have interests in most of these projects. And so this portfolio, and it's all Athabasca Basin focused, where you're not looking for these low-grade roll front deposits that everybody's all excited about in the United States and in places like Wyoming. Those ones, they're not really ever going to be able to compete with Kazakhstan. And by the way, most of the new nuclear reactor demand is going to come from China, and China is going to get all of its supply from Kazakhstan, and Kazakhstan has also dialed back its uranium supply. And with in situ recovery, it's easier to build that back up than it is for, say, Cameco to pull the switch and say, okay, MacArthur is going back online. We're going to start producing from MacArthur again. Kazakhstan can provide a lot of extra uranium if, for example, the Sprott Physical Uranium Trust wants to try and push uranium up into the $90, $100 range to get the market excited about all the other juniors that own uranium deposits. Well, Kazakhstan will have a lot of fun supplying that spot market and filling the boots of these various entities that are trying to warehouse the spot market and create a uranium squeeze on the upside. I don't think that's really going to work. But I think there will be interest in high-grade discovery, and Forum Energy just announced that it intends in Q1 of next year to do a $1.3 million program on its Northwest Athabasca JV, and it only has a 39.5% interest in this. The other partners are NextGen with 28%, Cameco with 20%, and Orano with 12.5%, but none of them want to participate in this program. And it is in the sort of northwestern part of the Lake Athabasca, on the edge of the lake. There is an old deposit found decades ago. It doesn't have a 43101 resource. It's about 600,000 tons of 0.6% U308, but it's perched in the sandstone. Forum Energy has developed some fresh ideas as to where they could find a richer unconformity associated uranium deposit in the area. So they'll have this program going, and there's also the possibility that Fur Island, Orano's program earlier this year was interrupted. They want to do another IP survey to see if it's worthwhile for Orano to try and go back in this first quarter. So it is this uranium portfolio, which I described as a bet that the broken uranium clock will one day be correct again. This portfolio is what is now driving market interest in Forum Energy, and if the Sprott Uranium Physical Uranium Trust boosters pull it off and do get the spot price up to $80-$90 a ton, and the long-term price, which is still stuck at around $33-$34 a ton, actually starts to follow, and that's a much harder act to achieve because those are long-term commitments that producers and users engage in. That's the key signal that the long-term contract prices start to rise, and they need to get back into the $50 to $60 a ton range, a pound range, because that's where it makes sense to produce these Athabasca deposits. That's where the roll front deposits that groups like Energy Fuels operate in the United States, that's where they start making sense. So there is a plan. There's a reasonable plausibility that we will see the long-term prices rise back to $50 to $60 a ton, but I'm not sure that there's going to be a big M&A boom amongst the juniors with deposits, because all those entities that hoovered up all those other deposits during that 2004 to 2007 boom, well, they still own those deposits, and those ones will have been the better ones rather than the ones that were left in the juniors, and those are the ones which will get the attention in terms of being developed and turned into future supply of uranium. So Forum Energy up because there is a uranium a bubble that they're trying to inflate, and they've cleaned up a good part of the spot supply. And if there isn't a lot more in the wings in the warehouses of the utilities that's ready to hit the bid, then we may have a little window here where interest comes back into uranium exploration for the juniors.
We'll have more with John Kaiser right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with John Kaiser. John, Colonial Coal has nearly doubled during the past week. What's going on there?
Well, Jim, I introduced Colonial Coal to Discovery Watch in April 2019, when it was in that sort of 30 to 50 cent range. I liked it because it is the only junior that has 100% ownership of substantial metallurgical coal deposits. And these are the two main ones are the Flatbed and the Huguenot, and they're located in northeastern British Columbia as part of a 1,000-kilometer long belt on the eastern flank of the Rocky Mountains, and almost all of it is controlled by about 5 majors, which includes groups like Anglo American and Teck, which operates the Quintet mine. And these groups, Glencore is also in there, they are the ones that mine this metallurgical coal and ship it to Asia, where it is used in steel making. So I like the company because metallurgical coal is different from thermal coal. Thermal coal has a bullet on its a target on its forehead in terms of being phased out of usage. It will take time, but eventually there will be no future for thermal coal. But coking coal is added to the furnaces along with iron ore in the steel making process, and it enables these furnaces to achieve the heat needed to make steel. But when I introduced Colonial Coal in 2019, they had spent $20 million on these projects, advancing them through PEA stage, and at the time, metallurgical coal was in the $150 to $200 per ton range. And they used $172 for Huguenot as a base case price and $165 for Flatbed. Huguenot's going to start as an open pit mine and transition to an underground mine, and Flatbed will start as an underground mine. And the company has about 183 million shares fully diluted. The CEO is David Austin, who was one of the founders of Western Coal Corp, which Walter Energy bought in 2011 for about $3.3 billion. Now, Colonial Coal had already been started at the time. They had successfully applied for leases in the Huguenot and Flatbed leases in 2007, 2008, but they kind of missed that takeover frenzy of 2011, spent their time in the past decade, and in 2019, it looked like they were ready to start the auction process. And what was interesting about the Western Coal Corp bidding war, which ended up disappearing at $12 in a $3.3 billion buyout, is it started off with Indian groups, and India is very much involved in steel making. They were engaged in the initial bidding process, but then when the frenzy came, they sort of snoozed and loosed. They didn't participate, and they ended up being scooped by the American company. And so they disappeared. So the hope now was that the second time around, they still have a strategic need for a secure supply of metallurgical coal. And northeastern British Columbia is about one of the best places to get that. So in 2019, it looked like the bidding might heat up. But then metallurgical coal sank from that $150 to $200 range back down to $120 a ton and languished there for a while. And the stock it had sunk down to 25, 30 cents. They got a bunch of warrants exercised. And then it sort of clawed its way back to the 70, 80 cent range where it has been parked for some time. Now, the odd thing is the stock really did nothing all of this year, even though as part of this general trend of metal prices rising, metallurgical coal has risen well above the $120 level where the PEA wasn't quite as exciting as it was when it was in the $150 to $200 level. And by the way, at a 10% discount rate, the Huguenot had an NPV of $831 million US, and Flatbed was $446 million at those $172 and $165 base case prices, and at today's exchange rate, that would be about 1.6 billion Canadian, or roughly $9 a share. So, meanwhile, this year, the met coal prices have risen, but nobody really sees it because all these groups that track the metallurgical coal prices, CRU, Argus, they're all very secretive about it. They do not publish charts on the internet. Even companies like Teck and Colonial Coal, who you think would put it into their presentation, they do not have charts of metallurgical coal prices. And they are complicated because the price of metallurgical coal depends on the origin and the destination. But what has been the sort of creeping story this year is that the price of Chinese imported metallurgical coal has gone up, up, and up. And part of the problem is that China, as part of a diplomatic spat with Australia, decided to ban the import of Australian thermal and metallurgical coal. So they have no longer allowed Australian coal to come into the country. Now, China produces most of its own domestic needs and metallurgical coals from its coal mines, which are generally underground mines, but it has also done some importing of coal from Mongolia. And their steelmaking industry has been roaring along since they dealt with COVID early last year. They went on an infrastructure spending boom to keep their economy going, and this has helped drive iron ore prices over $200. But recently, in the past few weeks, iron ore has collapsed back to $130 a ton. And the reason is that China has finally decided to do something about the polluting aspect of its steelmaking industry, and it has shut down that portion of its steelmaking sector which is very polluting, because they're becoming very concerned about a public backlash of China's policy of subsidizing its dominance in metal production by dumping the costs on powerless downstream victims. And that could really bite the Communist Party hard if it ever gets any momentum. So, of course, the result of cutting back steel production has sent the price of steel up and the price of iron ore down, and you would have thought that the price of coking coal, as metallurgical coal is also known, would also have gone down. Well, in the past week, it has soared to over $600. Last week, it was over $400 a ton. And the reason is that there have been a number of accidents in China that resulted in some deaths in these underground coal mines, and 22 coal mines have now been shut down because of these health and safety reasons. And the Chinese have a very strong aversion to deaths in coal mines. This is something that really, really bothers them, and it is a flashpoint for the government. So this has suddenly put China in a real bind, because it still needs the coking coal for its steelmaking industry, which is still chugging along, even though it's been curtailed somewhat. And they can't get anything from Mongolia because COVID problems there have disrupted the supply. They can't accept the Australian metallurgical coal because they're still in this diplomatic row over Australia accusing China of not being very competent in the way they handled COVID during its breakout period. But what's happening now in the world is North American metallurgical coal supply that's maybe going elsewhere. They're swapping that out for Australian coal. So the Australian coal that normally goes to China is now going elsewhere, and the North American met coal is going to China because China doesn't have a ban on that supply source. So the price of Australian met coal has also started to approach $300 a ton. And how sustainable all this is, I don't know. The big background is what is going on with the global economy. Are we indeed in a global economic recovery? is COVID being beaten? Well, when you look at all the metals across the board, you see very strong, at least in the base metals and minor metals, specialty metals, you see strong price gains. In fact, in August, prices for a lot of the more obscure metals like tungsten surged significantly. But you don't see any of this reflected in the resource juniors, like copper, nickel, zinc, juniors that have advanced projects in that. They are getting no love from the market whatsoever. It's as if the audience that is willing to bet on resource juniors and strong future metal demand is looking at the anti-vaxxer movement and concluding this is going to successfully sabotage the economic pandemic recovery, and it will probably undermine Biden's chances of staying in control of Congress in 2022, with the result that the whole clean energy movement and the infrastructure spending that's supposed to boost demand for all these raw materials, that will all go down the toilet and disappear. So there's this hesitancy out there saying, as long as there's this vaccine hesitancy and preventing this from, becoming just a bad memory, we're not going to go into these resource juniors that should be trading a lot better based on the metal prices that we're seeing in the physical metal markets. And that's really become kind of a bummer for us within Discovery Watch who monitor the resource sector. But the Colonial Coal situation may actually be a leading indicator that a switch is underway. And the fact that this stock ran from the 70, 80 cents up to $1.50, 60 has potential for a buyout in the $5 to $10 range. The key is if we see something like this happen, then that would be a signal that the people with the money who are looking at the long-term future, they expect this vaccine hesitancy to eventually disappear. The economic recovery will continue, the push for the transformation to clean energy, the effort to rebuild America's failing infrastructure and secure the future for the younger generations. All of that is going to prevail. So watching Colonial Coal to see what happens, to see if suddenly the met coal prices going way higher than they are on a sustainable basis will prompt, say, the Indian groups or even somebody like Anglo-American, which could benefit from absorbing the flatbed project, have them suddenly come out and make a move on Colonial Gold and show that, yes, the future is bright and open. We are not looking at an end times scenario.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser, his website, kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howestreet.com. Discovery Watch is a production of How Street Media Incorporated.